Welcome to The Explainer. Today we're going to tackle a question that every single investor asks themselves, probably all the time. How do you know if you're paying a fair price for a stock?
I mean, this is the question, right? It's the one that can keep you up at night. You find a company you're excited about, but is the price fair? Are you getting a steal, or are you just buying at the top of the market? Yeah, it's a huge problem for all of us, finding that sweet spot between what you pay and what it's actually worth.
Well, luckily for all of us, a true legend of the investing world, Benjamin Graham, you've probably heard him called the father of value investing, he came up with a really elegant way to help cut through all that noise. And what he gave us is something called the Graham number. Now, think of it less like some complex financial model and more like a quick shortcut. It's a tool that gives you a first-glance estimate of a stock's intrinsic value, what it's really worth deep down. The whole point, which he lays out in his amazing book, The Intelligent Investor, is to find good companies that are on sale, basically. Okay, and a really important heads up before we dive in. If you go and Google Graham's number, you might see something about math and an unbelievably huge number, like bigger than you can imagine. That is not what we're talking about. Totally different thing. We are strictly in the world of investing here, so just, don't mix those two up.
So, how does this thing actually work? Let's pop the hood on this formula and really see what makes it tick, what the different parts are. So there it is, the formula. And I know it might just look like a jumble of math, but it's not. It's actually telling a story about a company. It's weaving together its profitability and its financial stability into one single number. So let's meet the main characters in this story. First up, you've got EPS. That stands for earnings per share. This is your first, most basic question. Is the company actually making any money? It's just the total profit from the last year divided by all the shares out there. It's a super fundamental health check. No profits? That's a red flag. All right, next is BVPS, or book value per share. Now, this one's kind of like the company's financial safety net. Imagine the company had to just, shut down tomorrow. They sell off everything, their buildings, their equipment, and then they pay off all their loans and debts. Whatever cash is left over, divided by the number of shares, that's your book value. It's a measure of real, tangible stuff. And then there's that number in the middle, 22.5. Where does that come from? Well, this is the secret sauce. It's not random at all. It's actually Benjamin Graham's own conservative philosophy, like hard-coded right into the math. See, he had these rules of thumb. He said a stock shouldn't have a price-to-earnings ratio, a PE, higher than 15, and its price-to-book ratio shouldn't be over 1.5. So what do? You multiply those two numbers together, 15 times 1.5, and voila, you get 22.5. Okay, that's enough theory. Let's actually put this thing to work. This is where it stops being just numbers on a page and starts to mean something. So let's just make up a company. Let's say its EPS is $3.50, and its book value per share is $20. Okay, step 1, we grab our inputs. Step 2, we plug them into the formula. So we've got the square root of 22.5 times 350 times 20. You run that calculation and what do you get? A Graham number of about $39.69. Okay, so now what? The final step is to interpret this. We look at the actual stock price, which is $45. And since our Graham number is lower than the market price, this formula is basically waving a little flag at us, saying, hey, this stock might be a little on the expensive side right now. But, and this is a really big but, you gotta understand that the Graham number is not some magic crystal ball. It's a tool. And like any tool, if you want to use it right, you have to know what it's good for and what it's not. So let's talk about the fine print. First off, for this formula to even work, the company needs to have positive earnings and a positive book value. So no dice for companies that aren't profitable yet. It also completely ignores future growth. I mean, that's the whole story for a lot of tech startups, right? It also has these fixed assumptions like that 22.5 number. A PE of 15 might be a great deal for an old industrial company, but for a fast-growing software company, that might be totally unrealistic. And finally, it's all based on the past. It's looking in the rearview mirror, which doesn't always tell you what's coming up ahead. So let's boil it all down. When does it work? It's awesome for those stable, boring in a good way, profitable companies. The big industrial names, utility companies, stuff like that. And where does it not work? Well, it's pretty much useless for those high-flying growth stocks, tech startups that aren't making money yet, or even good companies that are just having a bad year. For those, it's just the wrong tool for the job. Okay, so we've broken it down, we've seen how it works, and we've talked about the fine print. So what's the big takeaway here? How should you actually use this thing in your own investing? Here's the most important thing to remember. The Graham number is a powerful starting point, not the final answer. It's not supposed to scream buy or sell at you. No, think of it as a great first pass filter. It lets you scan the whole market and quickly flag some companies that might be undervalued. It helps you build a watch list, a list of stocks that deserve a much closer look.
So look, the Graham number is a brilliant tool for getting a handle on a stock's price. But you know that old saying, right? Price is what you pay, value is what you get. Just because a stock is cheap doesn't mean it's a good investment. Which leaves us with a much bigger question, doesn't it? A stock's price is one thing, but how on earth do you measure its quality? Something to think about.